Good investors don't forecast, they prepare. A veteran investor's operating doctrine. I. Cold open. Prediction is ego. Preparation is survival. If your investment strategy depends on being right about the future, you are already fragile. The market does not reward those who guess correctly. It rewards those who remain standing when others are wiped out. 2. Reality shock. The illusion of knowing what happens next. Most investors believe investing is about forecasting. They want to know, where will interest rates go? Will the Fed cut or hike? Is Bitcoin going to $150,000 or back to $40,000? Will this stock double next year? Is the recession coming now or later? They think the edge comes from being right about the future. It doesn't. Let me tell you something uncomfortable after decades in the market. A majority of professionals cannot reliably forecast macro events. Not hedge fund managers, not economists, not central banks, not market strategists. History proves this repeatedly. Before the 2008 financial crisis, the majority of Wall Street models did not forecast a systemic collapse. Before the 2020 pandemic crash, almost no strategist had global shutdown in their base case scenario. Before explosive bull markets, consensus forecasts are usually conservative. Forecasting is intoxicating because it makes you feel intelligent. Preparation is boring because it makes you feel cautious. But markets do not care about your intellectual satisfaction. They care about your positioning. Here's the brutal truth. Forecasting makes you emotionally attached to one version of the future. Preparation forces you to respect multiple versions of the future. One creates fragility. The other creates durability. And durability compounds. Let me give you the operating model that separates gamblers from investors. The preparation matrix. Every serious investor should operate across 4 quadrants: bull scenario, bear scenario, sideways scenario, chaos scenario. Most investors only mentally prepare for one, the bull case. That's why they panic in the other 3. Let's break this down like a professional. 1. Bull scenario. If everything works, prices rise, liquidity expands, optimism increases, risk assets outperform. In this scenario, are you positioned to participate? Do you have exposure to high-quality assets? Is your portfolio structured to benefit from upside? Preparation here means you own asymmetric upside. You don't overhedge yourself into paralysis. You allow compounding to work. But here is the trap. If your entire strategy only works in this quadrant, you are not investing. You are hoping. 2. Bear scenario. If everything breaks, liquidity contracts, fear spreads, correlation goes to 1, volatility explodes. Preparation here means you survive. You don't face forced liquidation. You have liquidity. You are not over-leveraged. You don't depend on perfect conditions. The average investor asks, how much can I make? The prepared investor asks, how much can I lose without being eliminated? This is where most portfolios fail. Because forecasting says, I don't think a crash will happen. Preparation says, what if it does? 3. Sideways scenario. If nothing happens. This is the silent killer. Markets chop, returns stagnate. Excitement disappears. Most people lose patience here. They overtrade. They chase narratives. They increase risk out of boredom. Preparation here means you are psychologically stable. Your strategy does not require constant volatility. You earn through structure, dividends, yield, rebalancing. This is where discipline becomes an edge. 4. Chaos scenario. If the model itself breaks, pandemics, wars, black swans, policy mistakes, liquidity freezes, forecasting cannot model chaos properly. Preparation for chaos looks like position sizing that prevents ruin, cash buffers, diversification across risk drivers, No dependency on one fragile assumption. No excessive leverage. You cannot predict chaos, but you can survive it. And survival during chaos creates generational opportunity. The core principle, preparation, is not pessimism. It is structural humility. You are not saying, the future is terrible. You are saying, the future is uncertain. That single shift changes everything. Forecasting is binary, up or down, right or wrong. Preparation is probabilistic. It asks, what are the possible outcomes? What is the range? What is the distribution? What is my downside if I'm wrong? Let's simplify it. Instead of asking, will the market go up? Ask, if I am wrong, what happens to me? That question builds professionals. Most retail investors operate like this: strong opinion, large position, emotional attachment, forced reaction. Professionals operate like this: uncertain future, range of outcomes, position sizing, optionality. One is ego-driven, the other is survival-driven, and survival is the foundation of compounding. Let's illustrate this with two fictional investors: Investor A, the forecaster; Investor B, the preparer. Investor A, the forecaster. He believes rates will fall. He goes all in on long-duration growth stocks. He uses margin because he is confident. He ignores downside protection because the thesis is strong. If rates fall, he wins big. If rates rise instead, he is destroyed. His success depends on being right. Investor B, the preparer. She believes rates might fall, but she also considers they might stay high. She allocates across asset classes, keeps liquidity, sizes positions so no single thesis can ruin her, avoids leverage, plans rebalancing rules in advance. If rates fall, she participates. If rates rise, she survives. Her success depends on durability. 10 years later, durability wins because even if Investor A was right 3 times, one large error can eliminate him. Preparation reduces the magnitude of irreversible mistakes, and investing is less about brilliant wins and more about avoiding catastrophic losses. Forecasting feels powerful. It satisfies the need to feel smart, the need for certainty, the need to control the future, the ego's desire to be right. Preparation feels uncomfortable. It admits you don't know. You cannot control macro forces. You are exposed to randomness. You are not omniscient. That humility is rare, but markets punish arrogance faster than ignorance. Ignorance can be hedged. Arrogance cannot. The day you stop asking, what will happen, and start asking, what will I do if it happens, you transition from speculator to investor. That shift is invisible externally, but internally, everything changes. You pre-commit decisions, remove emotional reactivity, design systems instead of narratives, focus on process over prediction. This is the mental OS of professionals. They do not chase certainty. They engineer resilience. Let me leave you with this before we continue. If tomorrow's market does the exact opposite of what you expect, does your portfolio collapse or does it adapt? Most people don't like that question because they already know the answer. Most investors think preparation means being careful. It doesn't. Preparation is structural. It is embedded in how your portfolio is built, not how you feel. Over decades, I've seen investors operate at 5 distinct levels of robustness. Most never climb beyond level 2. Professionals live at levels 4 and 5. Level 1, opinion-driven strong macro view, concentrated positions, emotional conviction, reactive behavior. This investor is constantly forecasting. They win big when right. They disappear when wrong. Their survival depends on accuracy. Level 2, diversified but fragile. Owns multiple assets, no leverage, basic risk awareness. This investor survives normal volatility, but they have no contingency planning. They haven't stress-tested assumptions. They diversify assets, but not risk drivers. When correlations spike in crises, they are surprised. Level 3, structured risk control. Position sizing discipline. No thesis can ruin the portfolio. Defined max drawdown tolerance. Rebalancing rules pre-committed. This is where investing becomes professional. This investor understands it's not about how much you make in the best case. It's about how much you lose in the worst case. Level 4, probabilistic architect portfolio built across scenarios. Cash as strategic optionality, asymmetric exposure, liquidity awareness, psychological resilience. This investor designs the portfolio like a system. They ask, what breaks first in stress? Where is liquidity risk hidden? What assumptions am I unconsciously making? They are rarely shocked, not because they predict events, but because they expect surprise. Level 5, anti-fragile positioning. This level is rare. At this stage, volatility creates opportunity. Crises are deployment windows. Liquidity buffers become weapons. Optionality is intentional. The investor does not merely survive chaos. They improve because of it. They hold dry powder. They hold asymmetric bets. They allow time to magnify compounding. And most importantly, they are psychologically calm when others panic. Forecasting creates conviction. Conviction increases size. Size increases fragility. Fragility increases emotional pressure. Let's break this chain. When you forecast strongly, you increase exposure because you believe probability is high. But probability is not certainty, and markets are non-linear. One variable shifts, and your entire thesis cracks. The more certain you are, the larger you bet. The larger you bet, the smaller your margin for error. That is how forecasting quietly leads to ruin. Preparation reverses this. Preparation says, even if probability is 70%, there is still 30% risk. That 30% matters, so you size accordingly. Professionals don't size by conviction, they size by downside tolerance. That single shift changes everything. Forecasting tries to maximize accuracy. Preparation tries to maximize flexibility. Optionality is the bridge between the two. Optionality means you have the ability to act when conditions shift. You are not locked into one outcome. You maintain liquidity. You avoid structural traps. Cash is optionality. Low leverage is optionality. Uncorrelated assets are optionality. Time horizon flexibility is optionality. Let me say something most retail investors misunderstand. Cash is not doing nothing. Cash is waiting with power. When markets crash, liquidity becomes scarce. Assets go on sale. Those with optionality act. Those fully deployed rationalize. Preparation creates optionality. Forecasting consumes it. Here is the insight that permanently changes how you think. Markets are uncertainty machines. If you build your strategy around certainty, you are structurally misaligned. Read that again. Markets reward those who respect uncertainty. They punish those who deny it. Forecasting is a denial of uncertainty. Preparation is a respect for uncertainty. That's why the most dangerous words in investing are, "I'm sure." The most powerful words are, "I'm prepared." Once you truly understand this, you cannot go back to old thinking. You stop arguing about direction. You start designing durability. You stop trying to be impressive. You start trying to be unbreakable, and unbreakable compounds. 13. Real-world application, a 4-step preparation check. Before any allocation, ask, 1. What breaks this thesis? If you cannot articulate what invalidates your idea, you are forecasting. 2. How much can I lose without emotional damage? If the answer is unclear, your size is too large. If markets freeze tomorrow, can I survive 12 months? Liquidity determines longevity. Longevity determines compounding. If I am wrong, do I get eliminated or educated? Good investors lose money. They just don't lose survival. 14. The long game. Preparation feels slower, less exciting, less heroic. But here is what 20+ years teaches you. Big wins matter less than uninterrupted participation. Compounding requires time. Time requires survival. Survival requires preparation. The greatest investors in history were not perfect forecasters. They were masters of positioning. They structured portfolios so that upside was meaningful. Downside was survivable. Liquidity was available. Emotions were managed. Their genius wasn't prediction, it was architecture. 15. Silent pause. Imagine the opposite. Close your eyes for a moment. Imagine the next 12 months unfold in a way that contradicts your expectations completely. Interest rates move opposite. Crypto behaves opposite. Equities behave opposite. Does your system fracture or does it bend? This is not about pessimism. It is about structural honesty. XV end without CTA. The quiet advantage. In the end, markets don't reward the smartest forecasts. They reward the longest survivors. The investor who remains calm, liquid, and disciplined during uncertainty eventually inherits the gains of those who didn't prepare. Good investors don't forecast. They prepare, and preparation over decades quietly defeats brilliance.